simpler, profitable, and enjoyable. So one of our recent initiatives that came about on SME popular demand is the GlobalLinker Growth Talks series. So I'm very happy to introduce this series to each one of you. So honestly, growth never takes place by mere chance, right? It is the result of various forces working together. Our Growth Talk series brings together the forces of industry specialists and domain experts to share practical knowledge with our growing community of over 3 lakh plus SMEs. Today, we have with us one of India's most prolific investors, Mr. Sanjay Mehta. He has invested in over 150 plus global startups with an outstanding portfolio performance of 103% IRR versus the Indian industry's average of about 30%. So for any founder, Sanjay is first a friend, then an advisor, and finally an investor. He recently in 2019 founded 100x VC to make 100 investments annually. But not only do they provide capital, but also functional expertise, networking opportunities, and the path to grow and scale the business. With the belief that ideas are fragile, Mr. Sanjay and his team nurture them by being efficient coaches, strategy consultants, business mentors, and trusted advisors. So I can't wait to learn from him, and I'm sure each one of you are excited as well. So without further delay, let's get started. Over to you, Mr. Sanjay.
Hey, thank you, Malvika, and thank you all for joining for today's session. So the way I've structured this is 15-20 minutes. I've got a couple of slides to make you think and start, wondering what are the things which you can ask across. And while getting VC, while you are getting to pitch to VC, how does a VC think and what are the do's and don'ts? And especially the don't side of it, the mistakes which typically entrepreneurs make across while pitching to VC. So let's get going across stuff. So I'll just give you a brief on 100x.vc. What we do across is we are a first check early stage startup fund, SEBI registered, and we invest into moonshot ideas and work closely with founders to help them scale their business and raise the next round of funding. Till now, we would have reviewed across 10,000 plus deals, shortlisted almost 1,300, whereby we met those founders, engaged closely with them, evaluated, and funded around 39 companies. So we work on a class model. So we have finished across our class 1, class 2, and class 3 companies in which 39 were funded. Class 4 applications are open. Past performance, all of our portfolio companies, we funded around 74 founders. Out of that, 39 startups. The class 1 20 startups have raised around 26 crores after we have funded them, and class 2 11 crores kind of stuff. And ISAFE is something which we are very proud of, which is a simple investing document. So usually it takes large amount of time to fund across a startup. The closure time is anywhere around 3 to 4 months. We do it over the counter kind of stuff with ISAFE, which is India's simple agreement for future equity. And you can go to 100x.vc website and download that document. It's an open source, anybody can use it, no legal cost. It's a template which you can use across. Total of 118 investors funded through ISAFE. And SHA is a shareholder agreement through which 67% of the value came in, with 8 VC funds, 7 angel networks, and 5 family office. Out of the 39 startups what 100x.vc funded, we have created 359 jobs. That's one of the impact metrics which we measure across. So going next across, in case if you got great idea, you are looking to raise your first check, institutional money, initial check, look up on 100x.vc, and we invite pitch proposals on pitch pitch at 100x.vc. So it is said that, it takes a wise man to learn from his mistakes and a wiser man to learn from others. So we are just going to follow this whole mantra about learning from other mistakes and having invested into over 150 companies last 11 years. I've seen across typical mistakes entrepreneurs do across when pitching to VCs, right? And these are the why most of the deals get rejected. There are challenges. You can't raise funding from VCs, and let's try to address that. So the first one is when founder is working on an idea which is very complex and the founder is unable to communicate. So unless you have a very convincing pitch narrative, it's very difficult to attract investors, right? Investors' mind is tuned to reject ideas, and most of the time we have seen across founders will pitch their product, not a business, right? And VCs tend to look at business, not just product. Product is just one part of it. So they tend to look at the whole business and invest into business. So a complex idea may be very, very beneficial or useful product or idea, but when it has no value to the customer or investors, they can't understand it. So idea is you have to make it very simple to communicate. That's what I wanted to put across. The next one is, we see entrepreneurs trying to build everything in-house, right? And that's where the biggest failure happens, especially from tech entrepreneurs. They don't partner with other startups or other technology service providers, and they would like to build their own code, custom code, and everything takes time, and the whole priorities are wasted, and they keep on building the product and never release it out. So learn how to create partnerships and leverage other strengths and build your product for go to market. So this is a big plus point when we as an investor see you are able to leverage partnerships. We understand this founder has a bent of mind, this entrepreneur thinks across about scale and building partnerships. Many times we see across wrong hires made very early. So what happens across is when you hire people for their experience and not for their potential, right? So yes, credentials are important, but when people are not so hungry in terms of growth at early stage, it is very difficult to manage that kind of big those hires which come with baggage of entitlement. So if you do across hire from corporates, you may be at possibly the series B or C rounds of funding where you got enough capital to ensure that they are able to deliver to you. At early stage, you need somebody who can create culture and work on every department as what founders do across. So you need to be very clear about hiring people for their attitude and potential. Next is, many times founders are able to raise quite a significant amount very early. But what it happens and in turns happen is that founders then, spend too much time on building a business plan on how to spend, and they lose focus from the business. They don't plan how to build a business, but how to spend that money. And this gives, it's like having too much time. And that's why I always say, too much capital at seed stage, it doesn't help across. In fact, I always say that, when cash runs out, that's where the thinking starts. So idea is, you should look at, narrow down your focus, have a laser focus. And shortage of capital at early stage uh, helps you make those hard choices about what you will build and what you will not, right? So idea is, yes, raise capital, but enough to ensure that you are raising enough capital so that you reach to the next round metrics or a milestone so that you can raise the next round of funding. Don't raise too much money that you are lost, kind of stuff. This is one of the biggest reason why a startup fails, right? Because they build a product which nobody wants. Many of the startup founders think across saying that if they build a product, everybody will come across, right? It doesn't happen that way. So yes, you go all in, kind of solve a big problem, and you get some success onto it. But idea here is, if there is no user engagement or there is no market, there is no client which is existing. So that's why there is a theory which is called lean startup, where you are constantly doing iterations and trying to get feedback from various quarters before you release a product. So you want to have a product which everybody wants, kind of stuff. Then comes across, one of the biggest reason why founders fail is basically they don't have respect for money or frugality or budgets, kind of stuff. They don't have understanding of finance, cash flows, use of funds, and then they create across projections which are not viable to fund across. So idea is, we have seen enough projection. So let's say on an Excel sheet, they will put in the day one, they would have 20 people team. Now to hire a 20 people team will take 3 to 6 months time. So you will not be using or need that much capital to deploy across. So how can you really build a projection and a plan which is viable, right? And not spend recklessly on fancy office setup or customer acquisitions or promotions, right? So idea is, you are accountable when you take money from an investor, your shareholders, you are accountable to them. So please have that respect for money and show that in projections. The next one which I see across is very detrimental, while it sounds very exciting, saying that, oh, I've got the large contract from a big customer. Now, at early stage, when you are very small, now suddenly the company is now only working on that one customer and serving that customer. And that contract is like, virtually, it is like a back-end office for that large customer. So you may be working for the top company of India or US, or that Fortune 100 company. But idea is, you are supposed to be serving multiple customers, right? And you can't be getting choked by serving that one customer, right? And so at the early stage, you want to create you want to create a marketplace where multiple customers you are serving and scaling across. And you don't want a financial dependency working only for one customer. So I've seen many of the startups ending up working with that big customer forever, kind of stuff, and becomes a outsourced shared service center. Then one of the big reason is single founders, right, who believe that they can do everything themselves. These are like Superman founders who don't believe in team or delegation, and these are like lone rangers, and they can't build teams. They don't trust anyone. They can't delegate. My learning has been, single founders companies don't scale really well. They need great team, and every founder is a human. You've got limited hours of working, and you will not be able to scale if there is a decision fatigue in the company. So Superman founders typically, who believe that they can do everything and anything, are a big challenge to the growth. Raising wrong money from wrong investors with no reputation. So yes, capital is scarce and very difficult to raise capital, but challenge is, if you raise money from wrong investors, which means these are toxic investors, they don't know how to help founders, and rather than that, they will try to acquire more equity into the company or try to have unreasonable demands out of the whole business, kind of. So you need to be having across investors who can nurture your ideas. At early stage, your company is very, very fragile, and it becomes very difficult to scale. So you can't be raising money blindly without understanding what's the background of the founder. And the best way to find out what is how the investor behavior is to talk to their portfolio companies, talk to their founders where they've funded it before, and find out what's the pedigree of the investor, right? So don't take money from wrong investors with no reputation. And you will find many free fund guys who will say, okay, I will be an advisor, give me 2%, 5% equity. So avoid those kind of stuff. Then one of the things which repel or founders don't get funded is when they show across too much salary for themselves. If you are looking to generate income, please continue working with salary. Why become an entrepreneur? This is the place where you are out there to create wealth. So when you start paying big salary amounts to yourself by investors' money, it's a big no or a red flag for investors. So ensure that you are, taking. Yes, investors understand some salary needs to be paid across, but you need to understand the wealth creation which happens with investors. Today, when you pitch to an investor, the company is nothing. Let's say company is valued at 20 crore and 1 crore is getting invested into the company. Now company is now valued at 20 crore, so you are the majority shareholders. That is where the wealth creation has happened across. Now again, you will be taking in that much income. So from 1 crore, if you're going to take 50 lakhs as a salary, then business is not going to scale. You need money to scale the business, so money has to be into the company to build the business. So focus on wealth, not on incomes. Then, many times startups want to do everything and anything, and they pitch across saying that, okay, I can do this, I can do that, and trying to solve across every possible problem, which is not possible. So too many revenue models, multiple direction, and everyone is your customer. Like for example, software companies will say, okay, we're a platform, we can do everything, kind of. You need to have a laser focus, right? And just try to have that leadership into one geography, one region, one SKU, one. So just create that leadership position, and that's where you are able to showcase to investors, saying that you know how to use capital very, very efficiently. Next is, throwing away money to buy technology and people. So whenever there is a problem, startups start thinking across. Oh, let me try and get more people, and throw people at the problem, and building a world class product. If you look at the first versions of any successful unicorn, those are always going to be shitty, kind of stuff. Look at the LinkedIn. Every founder would be ashamed of their first version. But you have to start, you need to build on it, you need to iterate on it, right? And idea is the day when you start wasting money. So let's say I've seen across business plan saying that, okay, I need hardware infrastructure for million users. अगर million user hit करेंगे तो भी fail नहीं होना चाहिए. Day one, no million user is going to hit your website. It's going to take couple of years where daily at one point million users is going to come. You end up spending that money on that hardware infrastructure. It's a waste of money. So just keep iterating on the minimum viable product and build it to a scale. This one is very important, right? How do you create across path to profitability? How do you have business models which are going to make money, right? And it's not B2 offering. There has to be a visible plan to make money. You can't be building a business plan to burn and burn kind of stuff. The venture capital, yes, needs growth, but yes, VCs do look at part to profitability. You can't be having perpetual losses. So what is the pricing model? How are the costs aligned, right? So just try to work on the business model side of it. There is no mode. There is no unique IP, barriers to entry. It's just a Me Too services business, very easily replicable, right? And then you get outcompeted by other entrants in the market. So unless you have that unfair advantage, right, difficult to ape or copy, it's very difficult to raise money, right? If you can't fight or thwart competition and become a leader, VCs will not invest into that businesses. Not careful with equity allocation, as I mentioned earlier, right? It's okay to have some friends and family around, but don't give out free equity to advisors, and try to work on a compensation plan. So I've written a blog on how to compensate your advisors, right? Rather than giving away free equity. Equity is the costliest way of finance, right? So if you are doing compensation, go to LinkedIn, my LinkedIn blog, and read across how equity allocation can be done across at seed stage, right? And just ensure that you have got some vesting which is there over the years for those advisors or consultants, and ensure that a buyback option is always there. This is one elevator pitch which I would like to leave across for you. This is one of the slides. So in case if you want to have a simple way of communicating your idea, your USP, just fill in the blanks here, saying that if some investor meets you and you have to give an elevator pitch, this is the template which you can use across, saying that I intend to insert your product and service to a what is the type of customer, right? Insert the name and type of customer so that they will be able to insert the benefit value to that customer. Just fill in the blank, and it's your elevator pitch. And like anything else, practice makes the whole pitching perfect, kind of. So you need to practice, practice, and practice. And remember, how you say it is as much important as what you say. When you are meeting an investor, if there is no enthusiasm, there is no passion which is visible, it's very difficult to engage across. Next is, I mentioned in my earlier slide, saying that entrepreneurs love talking about their product, while investors fund a business, right? So how do you convert product to business? So always, whenever a founder will ask across me and pitch me, saying that I have built an 128-bit encryption, so I will ask, so what? So main kya karu? Kind of. So then they will come back. Oh, this security is unbreakable. So what? What does it do? It can transfer valuable credit card data safely without theft. Now, this is where you are creating a business case. This is where somebody will pay money. So tell about a use case, not how it works or what's that technical stuff. VCs would like to get into technical stuff, but maybe in a second or third or fourth meeting when they are evaluating your idea. But initially, they would like to hear a business side of it. Now you have done the whole, this is the most important slide on my presentation, kind of, and we'll break for Q&A. Please keep your questions ready. This is the most important slide where, whenever you are pitching to any investor and you talk across about unmet need, market size solution, all those details, right? How big the market is. What VCs here or uske dimag mein kya chal raha hai? Is there money to be made? VC's mind is working on, is there money to be made in this idea? Then comes across the team execution side of it, the financial projection. Are these people who can make me? And lastly, when you are talking across on terms of investment, your valuation, what are the exit opportunity, how much money I can make. So three things in any pitch a VC would put a tick in a box. Is there money to be made? Are these people who can make me money? How much money I can make? If you can give these answers to everyone, it just works beautifully, kind of. At 100x.vc, if you are pitching to us, what we look upon is, one, as founding team, what is your right to win? How large is the market opportunity? So we invest into very large market opportunity. The market size, if it is not beyond kind of $1 billion, it definitely does not excite us. What is the business model strength? What is that path to profitability? How are you pricing your product? What is that unfair advantage? What is that IP? What moat it is? And this is our internal compass in terms of conviction of 20x return. If we don't see saying that we will be able to make 20x kind of returns, we don't invest into, because end of the day, venture capital is a business. It's not a charity. So we try to work across closely with founders to build the business. What we have done till now is, in class one, our key startups, what we funded was health tech, fintech, ed tech. Class two was wellness, marketplace, clean tech. Class three, it was SaaS, vertical commerce, deep tech. And now class four, we are open. If you have got ideas, write to us at pitch@100x.vc. We work across is, we discover the whole ideas, discover those founders. We work with them to convert their thinking into exponential thinking, right? And convert that whole mindset. Then we expand their business and help them with industry connection. We give them access to investors, and we help them rise across on their business profitability. And finally, we help them raise across funding. We, end of the day, we are a discovery platform for endorsed deal for incoming investors. ISAFE is one which you can look up on 100x.vc. It's an safe notes have been very popular in West, in Silicon Valley, to raise funding. We have open sourced this whole document. You can download ISAFE from 100x.vc, and you will be able to learn across how simple raising funds can be. You will have no legal cost. Anybody can download. It's open source document called ISAFE. In case if you are looking to raise money, as I mentioned across, you can write to us at pitch@100x.vc and happy to answer any questions now. Malvika, can we invite questions now from all the participants? Happy to answer any.
Sure, sure. I'm sure all of you all actually have benefited a lot. And Mr. Sanjay, we already have a lot of questions pouring in. So I'll just take them one by one. So there's a gentleman called Mr. Nikhil. He's asking you how do you identify toxic investors?
So when there are unreasonable investment terms, right? So for example, let's say if an investor is putting 1 crore and they are asking you saying that, can you guarantee me 5 crore kind of return? Now that's a unreasonable ask. The investor can ask across 1x liquidation preference, which means a capital which they have invested, that is the only what thing they can guarantee from an founder. They can't demand more than that. In case of many of the time we have seen across, they ask for unreasonable equity, which means over 50% saying that stake. I mean, then there is no equity left on the cap table. Now, how will the new VC come into if there is no equity to fund across or buy into, right? So, and many times, the reputation of the investor is bad. The treatment to the founder is as if they are employees. So you want to work with nice people, right? And
Right.
you don't want to be taking money from people. So the way I mentioned across, right, the way to check across is go to their portfolio company, ask those founders saying that, is this investor worth working for? If there were bad times, how did this investor behave, right? And what is the advice? And you will get all these insights from its portfolio company.
Sure, sure. Thank you for that. Moving to the next question, there's a gentleman called Mr. Arun Kumar. He says, I'm a single founder and I want to build a team since I realize that I can't do everything myself. However, for that, I need money and investors want to see a team. So it's a chicken and an egg story. What do you advise?
So you as a founder, if you can't sell a story to another co-founder saying that, please join my company and let's both of us, you should believe into this idea. If that founder is not buying your idea, how do you think that an investor would be buying your idea? It is your job as a founder to be able to create a team which is aligned to that mission, that whole idea. And the co-founder is also putting his or her skin in the game. So it is your job as an entrepreneur to make all the other co-founders or team members believe into your idea, right? If an in so idea is, there are many times where entrepreneur will say, I'm in a job, I've got a great idea, I can build this product, I want to work in this, but if you give me funding, then I will leave my job. Now here, the way we think across as an investor, if he's not believing in his idea, he doesn't want to have a skin in the game, he's not taking risk, why should I be taking that risk as an investor, right? So unless you are a so-called big name, no investor is going to give you money first and then you prove. You need to prove your skin in the game and then ask for investor money. Chances of you to get funded is higher.
Absolutely, absolutely. So moving on, Mr. Sanjeev Rao, he has asked, you rightly spoke about profitability, but today a survey has been published that 76% of founders would focus on growth rather than profitability. So what is your take on this?
I said path to profitability, which means that I'm not losing money on each transaction, right? I
Right.
might be losing money on overall. So, for example, am I buying a product at, let's say, 10 rupees and selling at 5 to create growth? No, then no investor is going to fund. But if I'm selling at 10, I mean, buying at 10 and selling at 20, but I have got overall losses due to my advertising, cost of customer acquisition. That is fine to growth across. So today, if I have to invest, let's say, in Meru caps, or
Right.
possibly if I have to invest into a pizza chain, rather than I would invest in Swiggy, because Swiggy, it's a tech driven. I can grow the business very fast. But if it is going to be a pizza chain, I will have to find an outlet, find a franchise. If I have to do thousand kind of stuff, it becomes difficult. Now that's what it happened across in my portfolio called Oyo Rooms. I was an first investor in Oyo Rooms as an angel, and it grew much more larger than any other chain in the world. And that happened because they had a very lean model, grew very exponentially. So people would be looking at growth from an investor side, but there has to be a part to profitability.
Sure, sure. So the next on there's Mr. Rajesh Sethia. He asks, what is the minimum percentage of equity dilution which is justified for companies to ask for in their first check?
So typically, if you are raising across anywhere around 1 to 3 crore, uh, typical equity dilution would be 15 to 25%. If you are raising anywhere from 3 crore to 5 crore, maximum up till 35%, not beyond 35%. This is in India, typically the deals which happens across an Indian context.
Sure. So, Mr. Niranjan Gupta, he asks, what can be the ideal equity to give an investor for initial stage? So,
I think
I
the
think
same
you've
answer.
already answered that, yeah. Any other questions? So, there's a gentleman called Mr. Francis Jairaj. He asks you for your story.
I was an entrepreneur, started with a bespoke software company, built it to a level, then had a .com bug in 2000, started a .com venture, failed miserably, lost all my money, started a product company called Udyog Software India Limited, exited that, then had an enterprise analytics BI company called MAIA Intelligence, sold and exited that. Then almost 10 years was a full-time angel investor, and 2019 started this 100x.vc fund. And the whole idea was to simplify funding at early stage. There are not enough lead investors in India, where you can, who knows how to curate startup deals. And that's where 100x de facto becomes the lead investor. And once we fund any company, it's like a social proof. And after our funding, a lot of the VCs fund our companies. And that's where I shared my stats also.
Wonderful, wonderful. So, Mr. Surya is asking you how to make pre-money valuation for an idea for someone who's looking for VC funding.
As I mentioned across, you need to work with the interested investor in terms of your capital needs. So let's say, for example, to reach to the next round of funding, if you need, let's say, 2 crore rupees, right? Work backwards, saying that this is the milestone which you will achieve after 2 crore, which will help you raise the next round of, let's say, 5 crore or 10 crore. So you need to work backwards. Now, for that 2 crore, what is the significant minority which you can offer to any early stage investor? You need to work with them. There has to be enough equity on the cap table so that the new incoming investor can join the pool. So it is basically a mutual understanding which you can work with any interested investors.
Sure. So, there's a lady, Shesta. She's asking you how important is the UI and UX and product design of a tech product when founders are pitching to you?
If it's a great product, yes, it attracts across. But the first priority is the founder's background and their right to win. Next comes across the large market size, and product comes third in the priority to evaluate any startup funding.
Sure. So Mr. Krishna is asking, can we go to an angel investor in the MVP stage itself?
You should. There is no harm into that. You should raise some money. It helps you hire people, build your product more faster. Always go to, so at 100x.vc, we invest in MVP, pre-seed, seed companies. So happy to look at it. Please write to us at pitch at 100x.vc.
So there's another lady called Saloni Jain. She asks if there are any webinars or information that you could share on how to start your own organization.
I think that you should ask your consultant chartered accountant on how to do incorporations. Investors are more from the funding side and scaling your business side.
Sure. Um, there's so many questions pouring in that I'm not able to keep track. But yeah, there's another one that says, when you say founder's background, what exactly do you look for?
So let's say if a founder is trying to say work across saying that I'm going to build the new cancer pharma molecule, and founder's background is he's a computer science graduate, it doesn't work across, right? Not everybody is Elon Musk kind of stuff. So you need to have a background. So many times founders say that, okay, give me money, I will hire scientists and build that cancer molecule. Now that's not how it works across. We were looking for, so for example, I was invested in a company called LogiNext, which is an logistics analytics company. Dhruvil and Manisha, both founders, came from Carnegie Mellon graduates. Both had studied analytics. Both had worked into that specific sector, one in EY, one in, I think, IBM. And they had started this company. They had some traction into it. The product was ready. Now, they coming with that huge background on logistics analytics was a huge help. They studied there. That's their right to win, and today they are a very large company. Last round was Tiger Global, which funded across. And we as an investor exited at 16x value.
Wonderful, wonderful. So moving on, Mr. Manish Mishra, he's asked, in the ideation stage, how much equity needs to be given to seed investors, and what is the
I
amount that
answered
one
that.
should look for?
I think I answered that.
Yeah, so he also wants to know about what is the amount that one should look for as seed investment?
Depends upon if you can survive with 50 lakhs, don't raise 1 crore. If you can survive with 1 crore, don't raise 5 crore.
Sure, sure. Mr. Nikhil is asking if you can elaborate on how to build unfair advantage, particularly in the B2C space, like social media or fitness apps, like a first mover advantage.
So I would like to see across that coming from your end, but let me just give you one of the examples in my portfolio company. So, for
Right.
example, I've got one company in our class three, which is called BurnCal, which is into fitness. Now, what these founders did was they, they enabled across a lot of the fitness coaches for remote training. Now, when you are doing remote training, is very difficult to measure the posture, the right way of doing exercise. So, if you keep a phone with their app live, you can actually, the software of BurnCal can measure how many reps was done. They can record across whether you are doing the right way or not. Various stuff you can look up on BurnCal with this kind of stuff. Amazing computer vision kind of story what they've built across and complete marketplace. So these are the places where you build a moat, right? Where it's an unfair advantage, right? Where you've used an IP which is going to be a clear differentiator than anybody else. So that's the one which I would like to mention.
Right. Mr. Krishna has asked, what type of traction do you need to invest in a food tech startup?
The best action in a food tech startup is you need to have some revenue, customers. The product there has to be a repeatable sale, saying that the customers are buying it. So when we invested, again I'm taking a example of my portfolio company. called Kerala banana chips. Now, this is a just a simple product of banana chips, but made from Nendran banana coming out of Kerala. And these are no hand touch Kerala banana chips, packed like how a Lay's would be. And they were number one on Flipkart and Amazon. And the kind of, the flavors what they had was amazing. So that's where we ended up investing into that company.
Right, right. So another lady has asked if you can talk about where Zlingo went wrong, if you do think they went wrong.
I have no comments on that.
Sure. So moving on from Mr. Rahul Ranjan, how to envelop this startup from a possible takeover from an investor, as the money invested gives bargaining power and an angel investor can become toxic looking at the scale up of possibility.
Uh, as far as what I understand, and every VC in the world is, no VCs want to run a business. They would like the founders to run a business. I would rather make money by investing into, and that's the core, by investing into multiple startups rather than running one company, right? If I were to become an entrepreneur, why to start a VC fund? So there are this toxic investor which I was talking about are wrong investors whose ultimate goal is to hurt founder and make money. It's not like a win-win situation, right? And so many of the terms are toxic where founders end up working across like an employees. Yes, there are challenges which happens across with these investors, but as I mentioned across, it's your due diligence as an founder and entrepreneur that before you take money or sign any document, you get it lawyer reviewed or get at least references of that investor.
Right, right. Um, Next up is, do you invest in companies outside India which are
No,
founded by Indians?
no. 100x.vc only funds India domiciled founders. We don't fund anything outside India.
Okay. Pranav has asked, do investors, one second, invest in B2B service startups like digital marketing services?
No, we don't invest into services business. Yes, services business which are scalable, we do invest, which are automated, which has an IP, right? Which I can multiply it very quickly. See, the whole idea about venture capital is saying that can I scale this business exponentially? So
Right.
unless this is a non-linear business, so for example, let's say in digital marketing services which you are doing, let's say tomorrow you get 1,000 customer, your 10 people team will never be able to serve it. But yes, if you have built a software which is going to do digital marketing services, and using that software you can serve possibly million customers, and you are a 10 people team, most
Right,
happy to look at it.
right, right. Mr. Roshan actually asks, so if there is a past failed venture, how do VCs look at the founder?
They look at with much more respect, that you have done your mistakes, you understand what not to do in business as much as you want to know what to do. If you know what not to do, you will avoid costly failures. So we will have a lot of respect for failed founders, especially your passion to become an entrepreneur again, but a lot of respect to people who have failed and started again. In fact,
Wonderful.
in my portfolio, the same founder where I have failed and lost money, I've funded them second time in their second ventures, because I believe that it was not the founders which failed, it was the idea which failed. So I always back founders.
Right. Wonderful. So I think we'll take just a couple of questions more, but Mr. Nitin is asking, do you help in building a detailed financial model for a startup?
I have done, but I would see that the basic work is being done by founder. It is not my onus to build your plan. It is
Right.
not my responsibility, But once I believe that founder is genuine, and once I have bought into saying that this is the idea I would like to work, definitely we work with the founder to help them tweak and build and ensure that that business plan works for them.
Sure. So probably one last more, but Mr. Arun asks, what do you think about waste management as a sector for investment?
So there are specific funds which are into ESG, and if you have an idea into that space, you should target those funds. Your chances of raising money will be very high.
Sure. I think, Mr. Sanjay, we'll probably, since we're running out of time, we'll not take in any more questions. But yeah, if there is something, my team can put up an email ID where questions can be directed. So yeah, I actually would like to thank you genuinely from the bottom of my heart. It's been such a wonderful session today. And on behalf of GlobalLinker and the entire team, I look forward to having another session with you for the GlobalLinker Growth Talks, and also just become a friend, if not an investor.
Sure. Look forward, Malika. Thank you so much.
Thank
Thank you.
you. Thank you so much.
Bye.
Bye-bye. Thank you, attendees.